You all are warmly and respectfully welcome to our discussions of the pre-seen case study, and this is aiming for the exam, July exam of 2021. As you all know, the common pre-seen case study is common for all the subjects at the strategic level, and by now you would have gone through the case study and noted or paid attention to the required areas. This time the case has been given from education industry and I will not go through the case study from the beginning to the end, but I will take you through the important matters which I think may be important at the exam. And also one small thing, though this case study will be applicable not for the entire paper by 100%, that will be applicable only for the third question, which carries 50 marks. So then for the first two questions you need not to go through the case study. For the first two questions you need not to go through the pre-seen. It has got nothing to, first two questions have got nothing to do with the case study. So then the case study will be important for the third question, where there is the consolidation part as far as the financial reporting part is concerned. So normally the console question carries about 20 to 22 marks, last time it has been 22 marks, so will be this time. So then whatever the predictions we make should be only for question number 3, but let us see whether we can do some predictions for the first two questions as well. Do not expect us to replicate your paper by just looking at the pre-seen case study. Sometimes the students are under the impression that by doing the case study we will be able to predict and replicate the entire exam paper right in advance. So no one does the studies well, and almost everyone will be waiting for the last moment, and they just only watch the analysis videos just to see whether we can predict the paper, replicate the paper in full. So we can't do magical things, and we are not palm readers, we are not astrologists, and we do not know what the paper is looking like. Nobody knows, and this is a professional exam, and do not expect anyone to do it either. You all are going to be professionals, but to some extent we will be able to see what the group structure will be and what adjustments will be there and what areas we think are so likely of being tested. To some extent there are some tips, there are some hints, and we can see what the paper will be looking like to some extent based on the hints. But sometimes the unseen has got nothing, hardly has there been a connectivity between the unseen and the pre-seen. So there have been instances as such as well. So sometimes what we see, what we think is examinable will be there in the paper, or it will not be there in the paper, right. So do not heavily rely on this. This is not the be all and end all. Do not heavily rely on this. You need to study and go through the entire curriculum, entire syllabus. Why? The examiner is setting the questions from the entire syllabus. So you can't do selective learning, and that does not work at all at the exam. So the examiner, the paper setters, so everyone requires all the students to go through the entire syllabus without doing this selective learning. And also the writing, the most important part, you need to improve your writing part of it. You all know the answers, but it has to be shaped up according to the requirement of the examiner. So, that is what we have been repetitively telling you all, and those are the areas where the improvements are required. Please pay attention. I must tell you once again before we start our discussion, this is not going to be something like be all and end all. I mean, it is not going to be the paper discussions. It has to be kind of a supporting. So, you need to be thorough of the syllabus for the exam. Now, of the case study, first paragraph is about the background of Mr. Soisa, the major shareholder, one of the major shareholders, and second paragraph is the family background of the major shareholder or the founder of the company. And once again, the third paragraph speaks about Mr. Manilal, who has been the founder of the company. And number 2, company overview, shareholding, and the shareholding number of shares will be important. So, you need to keep it highlighted. Now, you can have the hard copy and you can keep the hard copy as well, your own hard copy. So, this is one advantage this time. If it is a physical exam, you are not allowed to take your own hard copy, which is highlighted, which is colored, which is underlined, where you have drawn pictures and done certain calculations on. So, this is the hard copy which you have got accustomed to, familiar with so much. If it is a physical exam, you are not allowed to take it to the exam hall, you will get a fresh one, but now you can keep it with you, you are allowed to keep it. So, keep it highlighted. This number of shares will be important, especially in the console questions, to understand the control stake, also the value of a share, 6,250,000 shares at 100 rupees per share, and keep it highlighted will be important. Shareholding structure is given: Manilal the Soisa 40%, Lalit Kiriyal 40%, Jagat the Soisa 10%, Lakshmi the Soisa 10%, total 100%. Then 2.2 human resources, I do not think that is of big use for financial reporting, and staff turnover has been spoken about. A voluntary retirement scheme has been proposed by the management. They have emphasized the requirement of such a severance scheme in the light of the global pandemic. CBE has access to foreign faculties, especially for final year students in the undergraduate and postgraduate programs. Academic staff also receive scholarships to pursue a master's or doctoral program at such foreign faculties. However, in such an instance, they are bonded for a specific number of years to the college by signing a memorandum of understanding. Right. Now, if you go to 2.2 human resources, first paragraph, second paragraph, third paragraph, 2.2 third paragraph. A voluntary retirement scheme has been proposed by the management. They have emphasized the requirement for such a severance scheme in the light of the global pandemic. Now, if the examiner maintains a connectivity between the pre-seen and the unseen, I personally feel that there can be a question from LKS 19, employment benefits. Now, not that do I assure and guarantee that there will be a question from LKS 19, but suppose the examiner tries to keep that connectivity and the linkage between the pre-seen and the unseen. So, there has to be a question from LKS 19. So, you need to go through LKS 19 and you need to brush it up. Employment benefits, so basically are taken into 4 categories. Short term employment benefits, short term employee benefits, other long term employment benefits, and post employment benefits. Post employment benefits and termination benefits. Termination benefits. And you all should be able to know what each of these benefits are, and to know how the accounting is done. At your stage, I don't think areas like short term benefits will be tested. In your exam, I don't think areas like other long term benefits and post termination benefits will be tested. So, in your exam, I personally feel that areas like post employment benefits will be tested. Then post employment benefits will be of 2 types: defined contribution plan, defined benefit plans, defined contribution plans and defined benefit plans. And if you go to LKS 19 to see what defined benefit plans and contribution plans are, it says defined contribution plans are post-employment benefit plans under which an entity pays a fixed contribution into a separate entity and will have no legal or constructive obligations to pay further contributions if the fund does not hold sufficient assets to pay all employee benefits relating to employee service in the current and the prior periods. Defined benefit plans are post-employment benefit plans other than defined contribution plans. Now, however much you read, sometimes you won't get it. Accounting standards have been written in a language and in a way that nobody should understand it unless they get someone else to explain. Now, let me explain. Say an employer promises to pay some amount of benefits to the employees, 10 million, and these benefits are funded. What does it say? The employer, in addition to creating this liability and recognizing the liability, keeps investing this money elsewhere in a way that they can pay the benefits to the employees as and when the payments requirement arise from those assets. Now, without being in a panic, so they can simply, now 10 million, they fund 10 million rupees from their business cash account, they can pull out 10 million rupees and invest elsewhere. Now, the employer does not have a fear. Why? Anytime when somebody leaves, without taking and drawing money from the business account so that the business does not get affected, they can start making the payments from this 10 million pool of assets. Simply, if you have a sister and she has to get married, so your parents will build up a fund. We will keep investing 100,000 rupees a month. The cost of the wedding will be 10 million rupees. So, by the time the wedding comes, at the time of the wedding, they have that 10 million rupees in their bank account. So, no headache, hassle free. Hassle free, it's not because your sister gets married, but they need not to find money hastily, they have that amount. Similarly, we can do with 10 million liability amount, and it can be paid to the employees using this asset portfolio. Now, the employer keeps collecting this amount 10 million rupees, and the employer does not have a commitment, fixed commitment to these employees, and he keeps collecting some amount. By the time the employees leave, the employer pays whatever the amount that has got accumulated in that fund plus whatever the amount of interest that has accrued to the fund over the period. So, the final benefit that should go to the employee is the aggregate of the total amount of the contributions to the fund plus whatever the income that has got generated from the fund. That is it. All what has got collected to the fund will be paid to the employees, and the employer just washes his hand. But now, the employer has a fixed commitment to the employees, and the employer says, look here, you will get 10 million rupee benefits by the time you leave. If everyone, there can be terms and conditions. So, they have to complete at least 5 years and leave for them to be entitled to the benefits, and they might say, look here, if you complete 5 years and leave, you will be entitled to 10 million. 5 years and leave, you will be entitled to 10 million benefit. Now, in this instance, the employer has been able to collect only 8 million rupees in the assets. Now, like in my previous illustrations, he can't just pay 8 million rupees and washes his hands, because he has committed himself and promised to pay a guaranteed amount of benefits. So, then apart from this 8 million rupee worth of assets in the fund, the employer has to fill the gap, bridge the gap of 2 million. Promised amount is 10 million, he has collected only 8 million rupees, and then he has to bridge the gap of 2 million rupees for the sake of payment of promised benefits to the employees. So, that is what the definition says. Defined contribution plans are post-employment benefit plans under which an entity pays a fixed contribution into a separate entity and will have no legal or constructive obligation to pay further contributions if the fund does not hold sufficient assets. In my previous one, we had 8 million rupees or 10 million rupees, we just paid 10 million rupees, that is it. We had not fixed and committed to a fixed amount of benefits. But we here in the second example promised 10 million and we have only 8 million rupees in the fund. So, now the employer has an obligation to pay further contributions, if the fund does not hold sufficient assets. The fund does not hold sufficient assets now, so the employer has to further pay further contributions by how much? 2 million rupees to pay the benefits to the employee. So, that obligation to pay further contributions to the fund will be of two types, will be either constructive obligations or legal obligation. Obligations to pay further contributions to the fund to pay the benefits to the employees will be of two types. What are these two types? Constructive obligations and legal obligations. Constructive obligations, as per LKS 37, of two types: past practice and published statements and policies. Now, if in the history of the company, Ever since the company was started right up to today, over a couple of 30-40 years time, the company ever had the practice of paying a fixed amount of benefits. And whenever the fund did not have adequate sufficient assets, the employer contributed the balance amount. That is the past practice. So, if the practice has been such, now the employer has a constructive obligations to pay the difference into the fund to pay that fixed amount of benefits to the employees. So, then the the post employment benefit plan is not a defined contribution plan, it has to be a defined benefit plan. Or they have a published statements and policies. It has been published anywhere, in any form, it has been published, and it has been made understand to everyone in the company who works in the company that in case the fund does not have adequate assets to pay benefits, the employer will will contribute to the fund to pay the balance amount of benefits. So, it has been published, it has been made aware to everyone who works in the company, to all the employees, that the employer will undertake to fill this gap to pay all the benefits to the employees, and then again there is constructive obligations to pay the balance amount into the fund. So, then it has to be a defined benefit plan. Legal obligations. If it is a legal obligations, it can be due to a contract. Sometimes the letter of appointment to the employee might say, look, this is our contract between you and the company. In case the fund created for the purpose of paying benefits for the employees does not have enough assets to pay benefits, we will fill the bridge, we will fill the gap, and then legal obligations are there. So, once again the post employment benefit plan has to be a defined benefit plan. Or there can be a Parliament Act legal, or there can be other laws, there can be a verdict or a judgment given by the courts, magistrates, ordering the company to pay the balance amount to the fund to pay the fixed amount of benefits. So, now if it is a post employment benefit plan, you need to learn, you need to scrutinize the features of the plan and just to see whether the employer has constructive or legal obligations to fund, to contribute to the fund, furthermore to pay the committed and the promised amount of benefits to employees end of the day. So, that is how you differentiate defined contribution plan from a defined benefit plan. Now, to give you a simple example, question number 1, just a model question. MPLC has 2 employment benefit schemes and the following details are provided. All of MPLC's new employees are auto enrolled into this defined contribution pension plan. However, MPLC has established a voluntary fund in order to provide enhanced benefits to these employees. MPLC has accounted for Plan A as a defined benefit plan. MPLC has a history of paying benefits to its former employees, even increasing them to keep pace with inflation since the commencement of Plan A. The main characteristics of Plan A are as follows. Plan A is totally funded by MPLC. The contributions to the plan are made periodically. The post-retirement benefit is calculated based on a percentage of the final salaries of plan participants dependent on the year of service. According to the underlying contract, MPLC can terminate Plan A whenever it wishes. If this occurs, then MPLC must fund lifetime annuities for retired scheme members. MPLC accounts for Plan A as a defined benefit plan. So, what is the question on that? discuss why it was appropriate to treat plan A as a defined benefit plan rather than a defined contribution plan. Right. So, you need to now, as I said before, you need to go through the salient features of the plan, and by going through it, what will you focus on? You need to understand whether the employer has a constructive or a legal obligation to fund to contribute to the fund further to pay the promised fixed amount of benefits. So, that is what you need to go through the features of the fund for. The main characteristics of the plan A are as follows. Plan A is totally funded by MPLC. The contributions to the plan are made periodically. The post-retirement benefit is calculated based on a percentage of the final salaries of plan participants dependent on the year of service. According to the underlying contract, MPLC can terminate plan A whenever it wishes. If this occurs, then MPLC must fund lifetime annuities for retired scheme members. Right. Now, there are important features to decide which category this falls into. It says, very important, MPLC has a history of paying benefits to its former employees, even increasing them to keep pace with inflation since the commencement of plan A. Now, sometimes with the inflation, the benefits keep increasing. In other words, the employer apparently, by beating about the bush, apparently the question says that the employer has committed a fixed amount of benefits and that keep increasing with the inflations, and when the final benefit amount keep increases, so the employer has been having a history of putting additional funds, putting additional contributions into the funds to pay that increased amount of benefits. A history, past practice. Past practice will create what? A constructive obligation. So, not only that, we have some more indications. It says post-retirement benefit is calculated based on a percentage of the final salaries of plan participants dependent on the year of service. And it says another important feature, if this occurs, then MPLC must fund lifetime annuities for retired scheme members. That again is an important feature to make you feel that this fund is a defined benefit plan. So, when you write the answers of a question of this nature, if it is a defined benefit plan, you have to include these key words in your answer. What is it? The employer has a constructive or legal obligation to contribute to the fund to pay if the fund does not have sufficient assets to pay all employee benefits relating to services in the current and the prior period. So, those set of words should be a must, and those are the key in your answer, and whatever you write without writing that the most important element in the answer, you won't get marks. So, this, as you go through and scrutinize the features of this plan, the plan has to be defined benefit plans. Why? This question or these features of the plan has given as many indications as the examiner thinks is necessary and enough to make you feel that this has here the employer has constructive obligations to contribute to the fund if the fund does not have adequate assets to pay the promised amount of benefits relating to the service of the current year and to the future periods. Right. Then if you move on in the case study, product portfolio 2.3, the main product services offered by CBE are given below: undergraduate education, postgraduate educations, professional executive educations and short courses. Right. The percentage of revenue earned from the above categories are as follows: undergraduate educations 20%, postgraduate education 30%, professional executive educations 35%, short courses 15%. Now this company is a private limited, but just one shareholder, as far as I can remember, that was Jagat, holding 10% of the share capital, is planning to go for listing. Since it is a private limited, apparently it does not fall into a specific business categories, and you can apply SLFRS for SME for your financial reporting. But since if it is an SME and you need not to think of segmental reporting, SLFRS 8, why SLFRS for SME does not talk about it. But now since one of the shareholder thinks of going for the listing, then you need to change it over from applying SLFRS for SME to full SLFRS adoption. Sometimes there are questions in the paper. There are some questions in the paper how a particular standard is adopted for the first time, as they are going to get the company listed, and then no longer are they going to apply SLFRS for SME and they are going to apply full SLFRSs. Also sometimes with this product portfolio, they will start doing segmental reporting as well, SLFRS 8. So then you need to go through SLFRS 8, you need to identify what operating segments are in the first place, and then to identify reportable segments. So we have done videos in our webinar series on SLFRS 8. You better watch them again to see whether you are updated yourself, and if this area can be examinable area in the paper, you can expect some questions from SLFRS 8. So see what operating segments are, what reportable segments are. With this product portfolio, you should be able to identify segments, operating segments and reportable segments. Then CBE has a student base of approximately 9,000. Course fee make up nearly 90% of revenue. Hostel fees, registration fees, library fees and resitting fees make up the balance revenue. In addition to its own programs, the college offers franchise programs at the undergraduate, postgraduate levels. All the courses that are franchised are subject to academic assessment regulations of the awarding body, partner university, due to affiliations with international partner universities. The college has access to foreign faculties. Nearly 20% of the enrolled students follow the degree programs of foreign affiliated universities. In addition to the main revenue sources stated above, the college earns referral fees from universities in China and Russia for referring Sri Lankan students to follow their MBBS courses. However, certain programs were rolled out without stringent evaluations and approval process by an experienced academic panel. Now, if that part is important at the exam, sometimes questions relating to SLFRS 15 can be expected. SLFRS 15 is a major area in the curriculum, and that is a heavy standard, and all the entities, if they are not, for all the entities should apply SLFRS 15, why all the entities generate some revenue or other. even though some entities do not have to apply SLFR is 16, SLFR is 8 and LK is 19 maybe sometimes, but every organization need to apply SLFR is 15. Why? Every business entity has some form of revenue or other. This kind of a business which is in the education industry has to apply SLFR is 15 to recognize their revenue, and they talk about franchise programs. You should know what it is. Normally a university, if you talk about a foreign affiliations like CBE Private Limited, so they have basically two kinds of programs. One is a validated program, the other one is franchise program, franchised program. So you should know what these are in case the examiner sets a question of SLFR is 15 relating to these two. You will know how they operate. If you do not know how they operate, your answering will be hard. Now say CBE is an affiliated university. There is an affiliated university say in UK, university say W. The name of that is W. It is a validated program. So what do you mean by a validated program? Here the program is done by CBE Private Limited. Curriculum is done by CBE Private Limited. Maybe they get the approval from UGC and they decide the assessment methods by CBE Private Limited, whether it is exams or whether it is assignments or whether there should be dissertations. So everything is decided, the courses are designed by CBE Private Limited, and that will be presented to the university and they validate. Okay, they might say, look here, you can continue, you can go ahead and you can do the program, but the degree will be offered by the foreign university. Degree will be offered by the foreign university. So it's like someone giving the name, that's a different matter, I mean we'll forget about that example. So here this is validated by the foreign university. So everything is done here in Sri Lanka or in this business entity CBE Private Limited, and finally they will offer the degree from their university. So finally, though you learned under CBE Private Limited, did everything under CBE Private Limited, you get the degree from the University of W in a foreign country. That is a validated program. Franchise program. Say they have another affiliation, University of S in UK. This is a franchise program. Here what happens is, you need not to do anything. It is the University S who will design the program, who will even prepare the curriculum, who will decide the assessment methods, whether it is by examinations or by assignments, whether there should be a dissertations at the end, and even the paper marking is done by them, or you do the paper marking and then you send it to University of S. And even the PowerPoint presentations, the materials are prepared by WS for the lectures here in CBE Private Limited. Franchise, you teach our program, you do according to our instructions, you need to comply with our requirements. Why? We are the people who ultimately offer the degree. So here it's like S will be like the principal and here it's like the agent, and there it is like a franchise. It's like a franchise. So you need to know how franchise related revenue is recognized as specially FRS 15. In addition to that, there can be some other areas where you need to pay your attention to. In recognizing revenue, so what those areas are, right. CBE Private Limited has the following revenue generating sources. And you are required to advise the company on how to recognize revenue at the following instances in accordance with SLFRS 15. A university's charges for tuition and housing are published on its website. Upon acceptance to the university, a student must pay a non-refundable deposit to hold a spot. The university sends a bill for the remaining balance due a month prior to the start of the semester. There is an add drop period when the student may receive a partial refund of the gross amount of tuition and housing charge. Now, if you get your enrollment and you need to pay a non-refundable deposit for you to reserve a spot for yourself, I mean that is the lodging facility, maybe the hostel, and that is what you make the payment for, non-refundable deposit. Before the commencement of the semester, the university sends a bill for the remaining balance due a month prior to the start of the semester. The balance has to be paid before, like 1 month from the commencement of the semester. There is an add drop period when the student may receive a partial refund of the gross amount of tuition and housing charges. So then simply what you need to understand is that a refundable deposit will be paid for the tuitions and lodging facilities for hostels, and you need to pay the balance amount prior to the commencement of the semester. Sometimes there can be a dropout, but it is not refunded. Now, how will you recognize revenue here? You need to apply 5-step model. What is the 5-step model? How many steps are there? Obviously 5. What are those? Identifying the contract, identify the performance obligations, determining the contract price, allocation of the contract price over the performance obligations, and recognizing revenue. Here the contract does exist. There is a commercial substance and a contract does exist. What are the performance obligations? Apparently in this illustrations there are 2 performance obligations. What? Tuition fees will be one, and providing lodging, hostel facilities will be another. And you all being students of a university may know that right around the university there are plenty of people who rent out rooms and lodgers for the accommodations of the university. So there is a market to get only the lodging facilities alone, right? So the customer can be benefited only from lodging. The customer can be benefited only from tuitions. So there are 2 performance obligations. Contract price, allocation of the contract price, and recognition of revenue. You need to recognize revenue of 2 sources here, lodging and tuition. Now here, as you recognize revenue, there are 2 types. One is where you recognize revenue at a particular point in time. The second is where you recognize revenue over a particular period. But whatever it is, revenue should be recognized as the performance obligations are satisfied. Now here, whether it is lodging or whether it is tuition, the customer consumes when the services are provided. If the services are consumed by the customer as the services are provided, as you provide the service, the customer consumes. As you provide, the customer consumes, then performance obligations are considered to be satisfied over a period. You need to recognize revenue over a particular period. Now likewise, there are many instances where revenue recognition of a university can be there. Many instances. This is just one. Another one, a university receives 13 million from a corporation. In exchange, the university agrees to name its new basketball stadium in the corporation's name. That name must be prominently displayed on the front of the stadium to certain specifications contained within an agreement between the university and the corporation. The stadium is located next to a heavily travelled road in the heart of the city where the university is located. The term of the agreement is 15 years. Right. Now simply what it says is, the university gets $13 million to name the new basketball stadium of the university in the name of a corporation, maybe another business entity in the commercial sector. So the university has entered into the contract to keep displaying that name, to display or to name the basketball stadium in the name of this entity over 15 years time. That is the agreement. There is only one performance obligation. Contract price is very simple, $13 million, and allocation is also very simple. Since there is only one performance obligation, 13 million should be allocated only to that. Recognition of revenue, it is revenue recognitions at one particular point in time or over the period, since the customer consumes the service from the service provider. As the services are provided over 15 years time, this 13 million should be recognized over 15 years period. So that's another source of revenue for a university, and you need to apply SLFRS 15 to recognize revenue. A university participates in a significant NCAA Division 1 sporting events. A commercial company obtains the license to use the university's name and logos. The commercial company manufactures various items such as clothing, hats, and memorabilia on which it plans to affix the university's name and logos. For these rights, the university receives $500,000. At the executions of a contract, the university will also receive a royalty of 1% of the sales price of any products using its name and logos. The term of the contract is for 4 years. Right. This university has been exceptional not only in academics, also in sports. Right. The university participates in significant NCAA Division 1 sporting events. A commercial company obtains the license to use the university's name and logos. The commercial company manufactures various items such as clothing, hats. Now, there may be a textile company that manufactures clothing, hats, and so on and so forth. So they will get the license from the university to display and to print to use the university's name and the logo on these clothes over how many years time? 4 years time. Now, for this license granted to this company, the university will get two payments. There will be a fixed payment of 500,000 and over 4 years time there will be just royalty payment of $1 for each item. That is what it says. Royalty of 1% on sales price, 1% on sales price. So, there is fixed consideration plus variable consideration. You need to identify the contract. The performance obligation is 1. Contract price, which is consisting of two considerations, fixed and variable. Now, you need to allocate the entire contract price to one single performance obligations, and then revenue recognition. Is it at one particular point in time or over the period? Now, even if you grant this company to display the name of the university on these products of the company, for this entity to keep doing that, the university must maintain their competencies, maintain their abilities, maintain their level at the required, to maintain that reputations at the required level. If not, this company will get embarrassed. If the university has been a complete failure in academics, also in sports events, it is embarrassing for this company to display the name of the university on the products of the company. So, the university has to make sure that they make all the possible efforts to maintain their positions, to maintain their reputations, and then only it will be worth being displayed. So, now just granting the license to display the name is not enough. After granting, you need to make efforts, you need to work to maintain your reputations. So, now as a result, you cannot just recognize revenue at just one particular point in time. The university has to recognize revenue over 4 years period. So, likewise, there are various instances. Another one, a university has a worldwide renowned marching band that recently completed the recording of marches by famous composers. The university enters into a contract with a vendor who wishes to use the recordings in advertisements. Significant terms of the contract include: the term is 2 years, the vendor receives a license to use the recordings in advertisements for that period, and the university receives a payment of $40,000 at the start of the 2-year term. So, you need to see how the revenue there is recognized. Another one, a university enters into a contract with a food service provider. The university grants the food service provider the exclusive right to operate all dining facilities and charge students for these services. In exchange for this right, the food service provider agrees to update the food service facilities by installing new equipment. Ownership of these capital improvements reverts to the university when completed. The university will also receive an agreed upon percentage of food sales to students to be remitted by the food service company to the university on a monthly basis. The agreement term is 10 years. So, let me explain that part. The university will allow an outside party to run the canteen inside the university. Now, the required capital natured assets to run the canteen has to be developed, has to be built up by the outside party. Now, these assets, capital nature assets developed within the university, will belong to the university when the agreement expires. Now, apart from that, over 10 years time, the university has to receive a percentage of the sales to the students from this outside party who runs the canteen. So, there are two considerations now. First is what? Non-cash consideration. non-cash consideration. What is that non-cash consideration? Non-cash consideration is the value of the capital assets that the university gets when the contract expires in 10 years time. The outside party who has taken over to run the canteen has to build up assets inside the university, and those capital assets eventually will become the assets of the university. So, that is the non-cash considerations, take it at fair value, and other than that the university has to receive an agreed upon percentage of food sales to university, food sales to students rather. University is entitled to a percentage of revenue of sale of food to university to the students. So, there are two considerations now. So, the revenue has to be recognized over 10 years time. Why? Because the outside part is the customer, university is the the entity who should recognize revenue. So, the outside party being the customer consumes the services of the university as and when the services are provided, So, the revenue on running this canteen has to be recognized over the period. Why? The customer consumes the services as the services are provided. So, likewise there can be various sources from which revenue should be recognized. I just took one or two instances, just few, and there can be some more. So, you need to be ready to, you can expect. Anyway, SLFRS 15 is highly examinable at the exam. So, I feel this time there can be a question, revenue related questions for this company. Now, 2.4, the college is investing in the constructions of a few new buildings to expand the business and the computer faculty. The student capacity of the college could be increased by 100% when the construction is completed. Project financing loan of 6 billion rupees to be dispersed in stages was obtained from the State Bank at a concessionary rate of 8%. In financial year 17 and 18, the bank offered a grace period for capital and interest payments, and this period expired on 31st March 2021. The final disbursement of the loan mentioned above will be received by CBE at the beginning of financial year 21-22, amounting to rupees 1.356 billion. The loan will be repaid in 5 years starting from financial year 2021 and 2022. The construction of the new building was delayed due to COVID-19, and this could adversely impact the opening of these new buildings, and that is a very important area. If the examiner set some questions, it can be related to LKS 23. What is LKS 23? LKS 23 borrowing cost. Right. So, this construction is a qualifying asset, and some additional informations may be given in the unseen, and they can go on capitalizing borrowing cost, but construction was delayed due to COVID-19, and this could adversely impact the opening of the new buildings. So, the examiner can test that part as well. If the construction has been halted for some times due to, and that delay was caused by COVID-19, then that was a suspension, or that was intermission of the active development of the qualifying asset for non-technical reasons, and then during that period you cannot capitalize borrowing cost. So, a question can be said, this is a very highly examinable area in your paper. So, you need to go through LKS 23 if the examiner tries to maintain the connectivity between the pre-seen and the unseen. I am pretty sure, in my personal view, there can be a question from LKS 23. Now 2.5 information technology, it says CBE realized that it was ill prepared for COVID-19 in terms of not being able to deliver its programs using digital tools. Therefore, it plans to invest in an integrated digital learning platform. When moving to a digital platform, it is inevitable that there may be excess staff, especially in the support functions where processes will be automated. A new brand strategy would need to be formulated with greater focus on online distance-based education. The finance department has also been experiencing issues with regard to generating reports required for management decisions making. The audit carried out by one of the international university partners revealed serious vulnerabilities related to cyber security and business continuity planning. Now, if they are going to develop their own integrated digital learning platform, that is like you know developing your own intangible assets, internally generated intangible assets. So, then the examiner can relate it to LKS 38 and can ask a question, how you recognize the expenses or the amounts invested on developing this platform. How do you recognize under LKS 38? So, you need to be ready, you need to go through LKS 38 and to see its connectivity, please. Governance issues in the family business, that is relating to the auditing part. Ethical issues you need to go through, but it is not for financial reporting, but maybe relating to auditing. Now, by and large, under the financial reporting, you need to expect financial instruments, the strategic paper, financial reporting paper, ABR paper at strategic level without financial instruments is like a wedding without the bride. So, this is of a wider scope and you need to get ready, though there are no tips or hints or indications relating to financial instruments, but there are a lot of items in the balance sheet relating to financial instruments. So, obviously, there will be questions from financial instruments. LKS 32, SLFRS 9, SLFRS 7. So, you need to go through. Second, as I said before, revenue from contracts with customers, SLFRS 15 can be tested. So, you need to be ready. Then sometimes SLFRS 8, if the company is going to be a listed company, SLFRS 8 reportable segments, there are informations enough in the pre-seen for SLFRS 8. Then there will be questions from LKS 23 borrowing cost if the examiner will maintain the connectivity between the pre-seen and the unseen. So, there will be some questions from LKS 23. And also there can be some questions from LKS 38 intangible assets, as I said before. And there can be some questions from LKS 19 employment benefits. The way the story in the pre-seen is structured. So, there are some possibilities of LKS 19 being tested. Then SLFRS for SME also can be a possibility, SLFRS for SME. So, you need to go through that, right. In addition to that, areas like LKS 14 investment property, areas like LKS 12 taxation can be expected. Now, let us look at the group structure. So, somewhere in the pre-scene, one of the shareholder, that was Jagat, has indicated that he wants to, here it says page number 1, the third paragraph, or rather second paragraph, it says Lalit is a businessman from Kandy and he indicated, it's Lalit not Jagat, I made a mistake, it has to be Lalit not Jagat, the second shareholder. Lalit is a businessman from Kandy and he indicated that he wishes to sell his shares in CBE as none of his children seem to be interested in joining the business. The D'Souza family owns a majority stake in the company. Now, let's look at the groups, the shareholding structure. Mr. Manilal has 40% and Mr. Lalit Kiriyalla has 40% and Mr. Jagat has 10% and Miss Lakshmi D'Souza has another 10%. Now, apparently, Mr. Manilal must be the person who is controlling the company for the moment. Why? He himself has 40% and his children, Jagat and Lakshmi, they are the family members. Jagat is the son, Lakshmi is the daughter. So, the family has altogether 60%. Now, as it says, the son and the daughter are very unlikely of voting against his own father. It happens, but in this case, it is not possible for us to assume that these two, son and the daughter, will be likely of voting against father. So, as a result, what is your conclusions? The family has the biggest equity stake of 60%, so they must be having the control. Mr. Manilal must be the person who controls the company for the moment with the support of the son and the daughter. Now, who wants to sell the stake? Mr. Lalit is the party, the shareholder who wants to sell his stake. Now, let us see what the group's, what the controlling position will be for Mr. Manilal even after the sale. Now, we talk about CBE Private Limited, Then still Mr. Manilal and his family has 60%. We will assume that Mr. Lalit sells that to another company called CBS. CBS acquires 40% from Mr. Lalit and still Mr. Manilal has 60% stake in CBE Private Limited. Now, in spite of the fact that CBS acquired 40%, still CBS will not be able to control CBE because Mr. Manilal has 60% together with the stake of son and the daughter. So, CBS does not get the control. Sometimes, depending on some indications in the pre-scene, you can conclude that the new company who got 40% from Lalit will be able to exert significant influence over CBE Private Limited. And do you expect the examiner just giving an associate company for you to do the consolidations at your level? Right, do not expect. So, there can be some more. Then, now this is just one possibility, there can be so many possibilities. Then do you ever expect either Jagat or to Lakshmi to sell their stake to CBS? No. Why? Blood is thicker than water. Jagat being the son, Lakshmi being the daughter, will be very unlikely of selling their stake to another outside party, so that father, their dad, loses the control. That is also very unlikely. Then here Mr. Manilal himself has 40% and CBS has 40%, the other two have 10% each. Somebody will mistakenly decide it can be a joint venture. Does it become a joint venture or joint operations or joint arrangements? Very unlikely, because the control is not shared between Manilal and the new company. Why? Mr. Manilal will be able to exercise control with the support of daughter and the son. So that is also unlikely. Now anyway there has to be a control questions. It has to be something more than just an associate company. Then one possibility is like the question in 2020 online exam in December. Sometimes CBS, after acquiring 40% from Lalit, would have had some potential voting rights. What can be the potential voting rights? Now CBS will be very unlikely of entering into share option contracts with Jagat and Lakshmi, because those two will be very unlikely of selling the stake and going against their own debt. That is also not possible. Sometimes CBE, now anyway they are in the expansion process and they are in the process of constructing some properties, buildings, and also they are in dire need of money at this juncture, and some problems with COVID-19 as well. So they might go for another financing technique like issuing a convertible bond. If CBE issues a convertible bond, and if CBS acquires that, you need to take the existing voting rights of 40% plus the potential voting rights. Remember, the potential voting rights are taken into account only just to establish the control, but in doing the control, now say for an example, they have 6,250,000 equity shares, CBE. Say CBE issues 200 million worth of a convertible bond, which is convertible into 2 million shares. 2 million shares. And the examiner gives you as many tips as possible in the unseen paper to make you feel that this conversion is likely. CBS, the new company, is very much likely of getting this bond converted into shares during the agreed period. If that happens, the total number of shares will increase from 6,250,000 to 8,250,000, out of which CBS holding will be how much? CBS acquired 40% from Lalit. 6,250,000 into 40% is 2,500,000, plus from this conversion CBS will acquire another 2 million, altogether 4,500,000. Let us take the percentage. Existing voting rights plus substantive potential voting rights, 2 million, altogether 4.5 divided by 8,250,000 into 100%. So there will be how much? 4.5 divided by 8,250,000 into 100. So it is 54.5. So let's say 55%. 55 is enough for you to exert your controlling powers over the invest. I am talking about CBS now. But as you do the console on the requirement of the examiner, this 55% is not what has to be taken into account. It has to be just what percentage, 40%, and 60% should be given to NCI. So that is very important to be remembered. If not, there can be another possibility. This is another outside company acquiring CBE, and CBE becomes the subsidiary company, and the new company in the unseen can be the parent company. That is also a possibility. The way the examine, the way the pre-seen is read, that is a possibility. If not, the picture can be completely different in the unseen, and the examiner can say CBE acquired another company, CBS. It can become a subsidiary company, and not just a subsidiary company. There can be sometimes a step acquisition. Or else, as I said before, CBS will acquire CBE with 40% from Lalit and with another potential voting rights, of which the informations will be given in the unseen. Now, there is another important information given in the question relating to the group structure somewhere at the end of the pre-scene. It says Jagat is very keen in listing the company, and this the business, CBE, has been very famous of being competent in the research activities. Sometimes a university will undertake the researches for outside parties, or they might do their own researches on their own. Now, another possibility is what? An outside company, say CBS will acquire CBE by acquiring 40% from Lalit, and there can be potential voting rights in the unseen, and CBE will acquire another entity which is a joint arrangement. Maybe CBE invested 50%, another part invested 50%. Then you need to apply SLFRS 11. It is going to be a joint arrangement. A joint arrangement can be of two. It can be sometimes a joint operation, so it can be a joint venture. And if for some reason you will conclude that this joint arrangement is a joint venture. So, the accounting part will be very simple, then you can apply what? You can apply equity method of accounting. But if it is a joint operation, it's not equity method that you can apply, you need to start recognizing the share of assets, the share of liabilities of the joint operations and the share of income and the expenses of the joint operations into the books of each investors. Maybe sometimes if it is an ongoing operations where they made the investment in, so you may have to do kind of a goodwill calculations. So, how do you differentiate or distinguish a joint operations from a joint venture? You need to look at SLFRS 11 for a moment. Let us quickly have a small look at SLFRS 11. Even SLFRS 11 can be a highly examinable area this time, as the examiner gives some hints and tips on that. You know, in your question, the examiner does not explicitly say that this company is a joint venture, so you need to consolidate. This is a joint operations, you need to consolidate. The examiner will not be that kind-hearted and generous, and by going through the structure and the informations in the joint arrangements, you should be able to conclude what it is, whether it will fall into that category of joint operations or whether it will be a joint venture. That part has to be very crucial and key. Depending on your understanding only, your accounting treatment should be applied. I mean, whether you apply equity method or whether you apply the method of recognizing the share of income, expenses, assets, liabilities, depends on your total understanding of the investee. So, that part is very important. Let me give you a small brief on that. SLFRS 11. If you go to SLFRS 11, we are given a lot of criteria to distinguish a joint operation from a joint venture. The terms of contractual arrangement. Joint operation, the contractual arrangement provides the parties to the joint arrangement with rights to the assets and obligations for the liabilities relating to the arrangement. Joint venture, the contractual arrangement provides the parties to the joint arrangement with the rights to the net assets of the arrangement. It is the separate vehicle, not the parties, that has rights to the assets and obligations for the liabilities relating to the arrangement. Now, if it is a joint arrangement without a separate vehicle, without a separate entity does not exist, then straight away you can come to the conclusions that this joint arrangement is just a joint operations, not a joint venture. But if it has a separate vehicle, a separate entity, you need to look at some other criteria for you to arrive at the conclusions. You need to look at the contractual arrangements that provides detailed guidelines, detailed explanations whether it has to be a joint operations or a joint venture. It is like this. If it is a legal entity like a limited liability company, sometimes still it can be a joint operations. Now, there are two parties, say A and B. A will contribute by assets to the total value of 60% assets. So, they are going to start a business of renting out properties to outside parties. So, the total requirement of properties will be say like 100 million. So, out of 100 million requirement, one party A has brought 60%, the other party has brought 40%. And accordingly they can decide their capital. Capital is 100 and this party has contributed by 60% and this party has contributed by 40%. Now the contractual arrangement provides the parties to the joint agreement with rights to the assets and obligations to the liabilities. So they have the rights to the assets and obligations to the liabilities, not to the net assets. Based on the rights to the assets and the obligations to the liabilities, only they decided their capital structure, capital contributions. But say here, they will decide, look, we need to have a capital of 100 million rupees, let us contribute to the capital by 60% to and 40% from me, but we will take the decisions together. We will share the decision making process and from this 100 million we will buy the assets. Now they have the rights not to the assets, they have obligations not to the liabilities, they have the rights to the net assets of the entity. Then it is a feature of a joint venture. In the previous illustrations, they have rights to the assets and obligations to the liabilities, not to the net assets. It's a feature of a joint venture. Then SLFRS 11 continues to say rights to assets, obligations to the liabilities, and revenues, expenses, profit or loss. If it is a joint operation, the parties to the joint arrangement should share the incomes and expenses, not the profit. Now in my previous example where the requirement of the asset was 100 million and A has contributed by 60% of the assets and this party contributed to 40% of assets, and that is the same basis on which they decide to share the income and expenses. And I might say, look here, out of the total revenue, let me share 60% of revenue and you can share 60% of your revenue. And out of the expenses, I will share 60% of expenses, you will share 40% of expenses. If it is a joint operations, the parties to the joint operations do not share the profits of the entity, instead they will share the incomes and expenses according to the agreed percentages, agreed shares. But if it is a joint venture, the parties agree not to just share the incomes and expenses, they will agree to share the profit of the company, profit of the company. Then if it is a joint venture, the assets are in the name of the N. If it is a joint venture, the assets are in the name of the entity and the liabilities were incurred in the name of the entity. But if it is a joint operations, the assets may be in the name of the parties to the joint venture. In the parties, the assets are in the name of the parties of the joint arrangements and the liabilities were incurred in the names of the parties of the joint arrangements. So those are very important features that distinguish a joint operations from a joint venture, and you need to see, by going through the question, you need to see how these features, how the joint arrangement has been structured and how it has been featured, and based on that only you will come to the conclusion. So I strongly feel the way it has been worded in the preceding case study, there can be some questions from SLFRS 11 as well, but it's not just a simple one. You need to go through the contents, you need to understand the features, you need to understand the contents and to see whether it is a joint operations or whether it's a joint venture. if it is a joint venture, how does the investor recognize a joint venture into the financial statements? Equity method. And you need not to learn it if you have done associate companies, equity method for associate company, that is the exact equity method which should equally apply to joint ventures as well. Recognizing the investment at cost initially and recognizing subsequent equity changes to the investment, and making sure that the investment and the equity method of accounting will reflect the investor's share of equity holding in the associate. This is the exact very thing you need to apply for joint venture as well. If it is a joint venture, just in your mind remove the word of a joint venture and you need to rename in your mind an associate. Remember, you can do the consolidations or accounting part of it as if it is an associate company. But if it is a joint operation, it can be little different. It can be little different. And let me do a small illustrations on that. Say company A and company B. Company A has sales 100,000, they have 80,000 sales. Cost of sales 60,000, here 50,000. Gross profit 40,000, 30,000. Expenses 15,000, 10,000. Profit here 25,000, here 20,000. Now, if it is a joint operations, not a joint venture, and this is the joint arrangement now, this has now become a joint operations as per IFRS 11. The other investor may be C. Now, A has agreed to share 50% of revenue from the joint operations, and so has C 50% of revenue and expenses. We will forget about C now, we will think of only A. How will you prepare the profit and loss? Very simple. Without you sharing the eventual ultimate profit, you need to go on sharing the items of incomes and expenses of the joint operations, then the consolidated or the total sales in the books of A should be now 140,000. How does it come? 100,000 from A and 50% from B should be 140. Cost of sales 60,000 from A and 50% from B 85,000. Then sales minus cost of sales will take the gross profit 55,000. Expenses 15 from A and 50% from B should be 20,000. Accordingly, the total profit in the books of A should be now 35,000. 35. So, should be the balance sheet procedure. Let me do a small illustrations on that as well, but these are subject to the adjustments to be given in the unseen paper. Say company A has invested in company B property, plant and equipment. This is 500 and this is 250. Investment in company B, say it is 400,000. Current assets, company A 200,000, this is 350. total assets 1.1 million, this is 600,000. Ordinary share capital, this is 700,000, 200,000. Reserves, this is 150,000, this is 100,000 or rather 250. Total liabilities 250,000 and this is 150,000. $1.1 million, this is 600,000. It was 50%. Now, you need, before this accounting treatment, you need to go through all the details, informations in the unseen to come to the conclusions, and your conclusions should be either it is a joint venture or joint operations. If it is a joint venture, no problem, equity method. Operations should be what I am going to tell you now, but what is important in your question is not doing this calculations, understanding what it is, and that is what most of the marks will be allocated to. Now on this date, A has invested in 50% of equity in company B. Since it is a legal limited liability company, there should be strong evidences that the investors to the joint arrangements have rights to the assets, obligations to the liabilities. They do not share the profits, they share only assets and liabilities, incomes, and there must be strong evidences, and you need to go through that so intensely and carefully. Now the equity figure is 450, and let us take 50% on that, that is 225. So the investment made by A to acquire 50% is 400,000, and you can calculate a small goodwill of how much? 175,000 goodwill. 175,000 goodwill, proportionate goodwill. Then you prepare the balance sheet. Property, plant and equipment 500,000 plus 50% from B 125 should be 625,000. Goodwill is 175,000. Current assets 200 plus 50% from B 175, 375. Ordinary share capital 700 only from A. Reserves 150 only from A. Total liabilities 200 plus 50% from B 75 should be 275. 0. Total liability should be 375 plus 150 plus 700 . $250 plus 75, 325 plus 150 plus 700, 1175. So this is how the balance sheet looks. Now those are the areas which I think are highly examinable in your paper, and just to summarize, you need to be thorough of SLFR is 15, SLFR is 8, then SLFR is 11, LK is 23 and LK is 38 intangible assets. SLFR is for SMEs, and especially financial instruments SLFR is 9, LK is 32, SLFR is 7, and the group structure you need to also look at SLFR is 10 to understand the group, the control, and those are the areas which I think are highly examinable this time. So just keep this in your mind and get ready for the exam. Just few days are left out. I suppose this will be of an immense use for you all to prepare for the exam, and all the very best for the coming exam. Hope you will succeed everyone at the exam. Thank you.